Good afternoon, everyone, and welcome to our latest installment of Michigan First virtual series on credit awareness. My name is Matt Martinez, and I'm the underwriting manager here at the credit union. And we are so very excited to have all of you on for this important event. For those of you that have been members with us for a while, hopefully you've had the opportunity to attend one or more of our credit awareness in-person seminars, which we typically hold 2 times each year. In those events, and in the span of 2 to 3 hours, we take a real deep dive into what makes up a credit score and how to effectively manage your credit to ensure that when you need to borrow, you have the best chance to get the best rate you can. This installment of our quarterly webinar series on credit awareness and management will show you how to use your credit score as a valuable financial tool to achieve long-term borrowing success. Before we get started, just a couple quick items of note. The chat feature within Zoom will be your opportunity to present questions to us, as we will not take any questions audibly. We have everyone muted and videos disabled, so please direct message Jamie Baker, or myself, Matt Martinez, with questions you wish to have addressed. The information presented today should last approximately 40 minutes, and then we will take some time to review and answer some of your questions before we end at no later than 1 p.m. As always, we are fortunate to have with us today the person that I consider to be one of the preeminent experts in credit in the industry today, the AVP of Lending Operations for the Credit Union, Mr. Brock Knoll. Brock has been with the team for over 15 years and has worked in the financial services industry for over 20 years, educating not only our lending team, but many of our members on how to best manage through credit and financial challenges to ensure that your cost of borrowing remains affordable long term. And so, without further ado, I will hand the presentation over to Brock to begin. Thank you, Brock.
Thanks, Matt, and welcome everybody. We appreciate you taking time out of your day to join us and learn a little bit more about credit. I know that today is probably a great day for us to do this virtually, as if you look outside, it's a little wintry, and we'd have a hard time probably getting people into the building today. So really appreciate your time. This is one of those virtual seminars that we've been doing that's more of a quick hitter when we talk about credit instead of the long one that we do in person. And January is the time of year where a lot of our members' credit tends to struggle. There's a lot of spending that happens in November and December. So we want to take this time early in the year to kind of reset with our members, let them know exactly what they need to do to get their credit back on track. It's not uncommon if you're tracking your credit score to see it dip right now, but it's okay. That happens to a lot of our members, happens to us. And there are some techniques you can use to get that credit score back up, and you can do it quickly. And we're going to teach you some of those techniques today. Like Matt said, we're going to spend time at the end taking questions, so go ahead and feel free to put those in the chat. We'll take time at the end to go over those. If there's anything that pertains specifically to you, or if you have more of a personal question that you don't want to be read out loud today, always feel free to get a hold of us. That's one of the things that we pride ourselves on here at Michigan First is our education for our members when it comes to their finances. For us in the lending team, that's really about credit and helping our members get their credit score back up. So anytime, it doesn't have to be today, that you have any questions about this, come on in. We have several experts here at the credit union that can talk to you and help you. So let's get this thing rolling. How do we improve your credit score after the holidays? One of the best ways and the easiest way to get a quick bounce back is something that we call credit capacity. Now, if any of you have been to any of our seminars before, whether it's a virtual seminar or whether it's the one in person, you've probably heard of credit capacity. If not, this is one of those things that a lot of us don't know about unless you work in the industry. A lot of members, and even myself before I started at the credit union, thought the only thing that mattered with my credit score was how well I pay. If I make my payments on time, I should have a high credit score, right? That's not always the case. There's several other factors that go into your credit score, and one that almost goes into it as much as how well you pay is your credit capacity. So we're going to talk about that, spend some time here at the beginning to talk about that. This is the fastest way to get your credit score increased, is to increase your credit capacity. It could be as simple as fixing something this month in January and having your credit score go up in February. That's how quick this can happen. So let's talk about it a little bit more. What is credit capacity? Credit capacity is something that is how much of your revolving credit you're using. And this affects your score 30%. So you look at that piece of the pie on the screen, it's a pretty big piece. The only bigger piece that we have is how well you pay. That's 35% of your score. So credit capacity is almost as much as that. So what type of loans affect your credit capacity? Well, it's mostly your credit cards, and it can also be unsecured lines of credit. So you take out a personal line of credit, that can also affect that. These are the types of loans where you have credit limits, right? So you can go out and spend a certain amount of money on these loans up to that credit limit. They give you the ability to pay them down and reuse them again. They call that revolving credit because you can use it, pay it, reuse it again and again and again. That's different than an installment loan, like a car loan or a personal loan, where you have a certain amount of time to pay that loan. And when you're done, you don't have a loan anymore. So there's a big difference there. Installment loans like car loans, personal loans, they don't affect your credit capacity. Credit cards and lines of credit that are revolving debt affect your capacity. If you want to define capacity, if you looked it up online, it says that it's the ratio of combined revolving credit limit or credit balances in relation to your combined credit limits, or the percentage of revolving credit available but not used. Now, that's a lot of words and a lot of jargon that's hard to understand. So what does that really mean? All of your credit cards and lines of credit have credit limits on them. On your credit report, that all gets added up into one number. How much could you go out and spend on your revolving lines of credit at one time if you really wanted to? Okay, so you add all of that up. How much of that are you using as a percentage? That's your capacity. Okay, so let's look at it a little bit deeper. And how do we calculate capacity? Because you can do this on your own if you don't have your credit report. Luckily for all of us, the credit bureaus do it for us. So if you get your credit report pulled, or you have one of those nice apps that you can check your credit on, it should give you your credit capacity. So let's just use a really even number because I'm not very good at math. So let's say you have $10,000 in available credit limits that you could go out and use right now. Let's say today you're using 4,000 of that. So let's calculate our capacity. You take your credit limits, in this case $10,000, and you subtract your balances, in this case $4,000, and what do you have left to spend? $6,000. So you take that $6,000 that you have left to spend and you divide that by your credit limits, which in this case is $10,000. That leaves you with 60% capacity. Okay, so you're using 40%, but you have the capacity to use 60% more of your available credit. That's how you calculate your capacity. And the credit bureaus will do this for you. They'll take all of your limits, shoot in a number, and how much of that are you using? You divide it against it, and that's how you get your capacity. The higher your capacity is, the higher your credit score is going to be. In fact, and this isn't exactly 100%, but it's pretty close, each percent of capacity that you gain approximates to 1 point on your credit score. That's huge. That's very powerful. So if you think about it, if you're maxed out on all your credit cards and you don't have any capacity left, you're really robbing yourself of about 100 points. And you're never going to get a score into the mid to upper 700s into 800 if your capacity is not good. So if you're middling in the 600s and you don't know why your score's not going up, it might be because your capacity is not good. And we want to get that changed around, and we're going to show you how you can do that today. So if you're maxed out on your credit cards, you have a huge opportunity right now to boost your score. And that's why it's so important to talk about this after the holidays, because myself included, we put a lot of our Christmas gifts or holiday gifts and whatnot on our credit cards around the holidays. And then we try to figure out how are we going to pay this after the holidays. And there's several techniques that people use, but there are some things that we can help you with here at the credit union that can make that process faster. I call this the holiday hangover right around this time of year as far as credit goes. Why did my credit score go down? And then similarly, how can we make it go back up? And the one thing that we're focusing now is that capacity. How can I increase my capacity? Well, first of all, you can open a card with Michigan First. After the holidays, opening up new cards or using cards with companies that help you with your credit score is a great way to get this started. You can pay down your revolving debt. Okay, so you could go out and pay your credit cards off. And I know that sounds crazy to some people, myself included. I can't just go out and pay all of my credit cards off right now. I don't have the funds for that. If you do, it's a good idea to do that, but not all of us have that option. So what's another option we can have? Well, we can raise our current revolving credit limits. So let's say in that scenario we talked about earlier, you have $10,000 credit card, and let's say that's your only credit card. Let's say you're maxed out on that credit card. So you've used all $10,000 of that. Your capacity is at what right now? 0%. You don't have anything available. Well, let's say you called that credit card company and said, hey, I was looking to get an increase on my credit limit. What can you do for me? And they say, sure, we'll increase your credit limit to $20,000. Well, what have you done to your capacity right there? You still have that $10,000 charged up on it, but now your limit's $20,000. Your capacity has gone from 0 to 50% because you're only using half of it. You've gained right about 50 points on your credit score in 1 month. That's how powerful this is. So you can do a combination of these two things as well. You could pay down what you can, because again, not all of us can just go out and pay off our credit cards. Pay down what you can, see if you can get an increase on some of your limits. And if you can't do it all, that's fine, but any little bit helps. Every percentage point that you can gain is about a point on your credit score. That's why this is so powerful. Another thing you should do, and all of us should be keeping an eye on our credit, at least one time a year, maybe even twice a year. There's apps that can do this for you now. You can get a free copy if you come in and talk to us at Michigan First. You can get free copies from the credit bureaus, but we should all be checking our credit. One of the things that you should be checking is to make sure that all of your HELOCs, your home equity lines of credit, are reporting as mortgages on your credit report, not as revolving debt. There are some companies out there that make this mistake, and when they report your home equity line of credit to the credit bureaus, they report it as a regular revolving line of credit. Well, most of us take out home equity line of credit because we want to do some work around the house or we need something else. We use that money. And when we're using it, that can cause your score to go down. So make sure that your home equity lines of credit are reporting as mortgages. Also, you want to make sure that the credit cards that you have out there are reporting your credit limits. There are some companies out there, and I don't really want to name them, American Express, that and Discover, again, I'm sorry, I got to name drop them, that are going to show that you have a balance with them, but they're not going to report your credit limit. And I don't know why they do this, but what it's going to do to your score is tank it. Because if you have a $5,000 limit, or I'm sorry, if you have a $5,000 balance on your Discover card, but they're not showing a limit on there, you're showing as way over maxed on that credit card. So if that's the case, you want to give them a call and say, hey, I need you to report my credit limit immediately. And if they say no, it might be time to move on from them. Come open a card here at Michigan First. I promise, we'll report your credit limit, right? And make sure you get credit for that capacity that you need. Another thing you can do, and another way that you can increase your score swiftly, is to take out a debt consolidation loan. Come into Michigan First. We can let you know if it's a good option. We can give you some coaching on that. And if it is, and if you can save some money on a monthly basis, which typically you can when you do a debt consolidation loan, then we'll tell you, go ahead and move forward with this. Or if it doesn't make sense at the time, we'll tell you the same thing. It never hurts to come in and ask and come in and talk to us. So let's talk about debt consolidation loans. This can also give you a quick capacity rebound. Because like I said earlier, installment loans don't affect credit capacity. And if you do a personal loan with us, which was a debt consolidation loan, or even if you do a debt consolidation loan with using your home's equity, those are going to be installment loans if you do a fixed home equity loan especially. that don't affect your credit capacity. So what are we doing with those? Well, not only will you have an end date in sight, because let's face it, if you take out credit cards and you only make your minimum payments on credit cards, I'm here to tell you, you're never going to pay them off in your lifetime. You can even look on your statement. It's in the fine print. It will give you a date of when you're going to pay that off. Last time I looked at mine, it's going to be after I'm no longer here. And I hope to live for a long time. But there's an end date in sight when you do a debt consolidation loan because you have a fixed term. Here's how much time you have to pay this loan off, and when you're done, it's over, okay? But again, those are installment loans. So what you're essentially doing is taking your revolving credit that is affecting your capacity, you're paying it off with a different type of loan that's not affecting your capacity. You're not taking out any more debt. You're just shifting it from one type of loan to another. And that frees up all your capacity. If you can pay it all off, you could see an increase, substantial increase on your credit score. The one thing you have to remember when you're doing debt consolidation loans is you have to be patient and you don't want to charge those balances back up. There's been members that I've helped over the years that I've seen get into a vicious cycle where they do a debt consolidation loan, they pay off their debt and everything looks good, but they go back out and they use those credit cards again. Then when they pay that debt consolidation loan off, they have to go back and pay off all that debt again. And they're just going on and on and on, never really getting themselves out of debt. So you have to be patient because a lot of times, especially if you have a lot of credit card debt, you could have a 2, 3, 4 year loan on your hands for debt consolidation. Be patient that 2, 3, 4 years. Make sure you get that debt paid off and try not to charge your cards back up. Okay. So it's not a quick fix in essence of paying your debt off because it can take some time, but it is a quick fix for helping your credit score. The shorter term that you can do on a debt consolidation loan, the better, for a couple of reasons. Obviously, you want to get the debt paid off as quick as possible. So that's your first reason. You want to get out of that debt. You don't want to have it anymore. But the shorter term that you do, the less interest you're going to pay on that loan. Because if you take a loan out for a long time, it just kind of extends that interest and you end up paying more interest in the long run, right? So even when you do a debt consolidation loan, if you're making your minimum payments, if you have any extra money that you can throw on that minimum payment towards the principal, go ahead and do that because the faster you pay it down, the less money you're going to pay out of pocket. If you pay more than the minimum payments on your credit cards, a debt consolidation loan definitely makes sense for you. A lot of times on credit cards, you'll have a pretty low payment because they just figure out your payment based on a percentage of your balance. So a lot of times, you're only paying, let's say you have a $1,000 credit card, your minimum payment's usually only $15, $20, $25, right? But again, that's not paying off that balance. But if you're paying more than that, you can probably afford a debt consolidation loan because your payment's going to be a little bit higher on your debt consolidation loan, but you get that benefit of paying it off with a term and paying that debt off faster. It might make sense for you even if your monthly payment goes up. So let's say your debt consolidation loan that you're presented in front of you has a higher payment than what you're currently paying on your credit cards. It might make sense for you to take that because you want to get out of that debt. So you really have to look at it. Don't compare the two payments together necessarily if you're paying more for your debt consolidation loan. Think to yourself, can I afford to make that payment on the debt consolidation loan? Because if I can, I'm going to get out of this debt that's just hanging around and I'm never going to pay off. So even if the payment's a little bit higher, it might make sense, especially if you're doing a very short term. If you're doing a 12-month term, 24-month term to pay off a lot of debt, sure, your payment's probably going to be high, but just think about the benefit. In a year or two, you're going to be all out of that debt and it's not going to be there anymore. Think of the relief off of your shoulders, that burden sometimes you feel from having debt. If you can get out of that, I'm telling you, it sure is a relieving feeling and it can put yourself in a better financial spot for the future. Let's look at some debt consolidation examples. I know we've been talking about it, but sometimes it makes sense just to look at dollars and cents. Let's look at some examples. So I have 2 examples here of what you can do. And this is really going to tell you the difference too of if you want to take it out for a longer period of time or a shorter period of time, so you can really see the savings you can make. So let's say this Christmas, you had a great Christmas. You went out and spent $10,000 for the holidays. You bought everybody all the presents that they needed. You spoiled everybody, which we tend to do if we can, right? So let's say you spent $10,000 on the holidays. There's two scenarios I want us to look at. The first scenario would be taking that $10,000 and doing a debt consolidation loan for 60 months. That's 5 years. Your interest rate on that is going to be 14.99%. Your monthly payment there is $237.75. That's pretty affordable for a $10,000 loan. The interest that you're going to pay over those 5 years, though, is $4,264. Okay. So elongating that term, boy, that sure costs you on the interest. So really, you're going to pay for the $10,000. You're actually going to pay over $14,000 in total for that loan. Let's look at a different scenario. In our example number 2 here, it's the same $10,000. It's the same interest rate, 14.99, but we're doing a 24-month term. That's 2 years. So we'd be shaving 3 years off of that payback on this. Okay. Now the payment's higher, right? You're going to be paying $484.55. That's $246 more a month. That can be a lot. That's a lot of money. But look at the interest that you pay in that shorter time. It's only $1,629. That's significantly lower than the longer term. And over $2,600, $2,600 less in interest, right? You're really not paying that much more than the $10,000 in that regard. You're only paying about $11,600 for that loan. Same interest rate, okay? That's the difference of shortening those terms can be. So even if the payment goes up a little bit from what you're paying now, that money that you save in interest, if you can afford it, is well worth it to you in the long run. So either one of these options can be good for you. You want to get out of the debt if possible, right? So you have to decide what's more important to me, saving money on a monthly basis or paying the loan off faster and saving money in the long run. And that only you can answer. You really have to think about it and you make the decision. These are the options that we can present to you here if you come in and talk to us. And we'll give you all these options. We can even give you more options than this, right? Do you want to do a 3-year term, a 4-year term? We can look at all of those, see what the payment is, and see how much interest you're going to pay over the life of the loan. We present you with all these numbers and let you make the decision. We can give you our advice, but ultimately it's up to you on how you want to handle this. I can just tell you this, without a doubt. If you don't do a debt consolidation loan and you just pay your minimum payment on your credit cards, it's going to take you forever to pay those off and you're going to feel the burden of that debt for much longer. So debt consolidation loans can be a great thing for you, especially after the holidays. All right, so let's talk about the coming year and potentially how you're going to see some impacts on your credit score. I don't know if anybody saw in the news recently, but on the 7th of this month, so just over a week ago, the Consumer Financial Protection Bureau, you may have heard of it as a CFPB, they finalized a rule that would remove 49 billion, that's with the B, in medical bills from credit reports of about 15 million Americans. Now, there's a big backstory behind this. A couple years ago, they made some changes to where it had to be over a certain amount to report to the credit bureaus, but finally they came in and said, you know what? People's insurance and how they pay their medical bills should no longer affect people's credit score when they're trying to go get financing for a house, a car, you name it. And personally, I think that's a good thing, and it's a good thing for all of us consumers. So if you've had a medical collection hanging out there on your credit report, you should see that go away this year. And what that's going to do, take that collection off your credit report, you should see a boost in your credit score. So that's a great thing for all of us this year. So if you've been waiting to make that decision on a debt consolidation loan or trying to get yourself out of debt, and you've just been, hamstrung by medical collections and just gave up on the notion, take a serious look at it this year because you can see a jump in your score. And the other way that you can make a difference this year is to get that capacity increase. Do a debt consolidation loan. You could even, if there's other collections that you have out there, you could pay those off too with a debt consolidation loan, and that'll make a huge difference in your score. Taking a negative item like a collection off of your credit report is huge. it can boost up your score. And when you combine that with a capacity increase, now we're talking potentially 100 or more points on your credit score. So just think about it. If you're down in the 500s, if you're down in the 600s, and you want to get up there to the A and A plus credit tiers, could be a crucial move for you to make this year. And if you don't have any capacity or you want a really good credit card with people who care about you, come to Michigan First and get our Michigan First Experience credit card. It's a rewards card, just like all the other ones that are out there, so you can get rewards points that you can use later on things. Come in and talk to us about opening ours. And that's another good point. If you don't have any credit cards, and trust me, I've spoke to a ton of our members over the years who say, Brock, I don't want any credit cards. I'll get myself in trouble. I don't need them. And I hear what they're saying, and I always say the same thing. That's fine. You need a credit card, else you're not going to have any capacity on your credit. So you're robbing yourself of a lot of points if you don't have any revolving credit. At least open up one. Come in and get ours. You don't have to have a high limit if you don't want. And you put that baby on ice. Stick it in the freezer in a bowl of water, and you can never use it. Or put it in your safe. Do whatever you want with it to hide it. Don't pull it in your wallet if it's that tempting. Leave it at home. And that's going to help your score. Okay, so come in and talk to us about that, or come in and talk to us about anything. These are things, and I know we go a little bit fast in all of this today. If you need more time, if you want to sit face-to-face with somebody, we have a ton of branches. Go on our website. We're in a bunch of grocery stores around the area as well, so we should have a branch close to you. And if you don't, if you're out of state, if you're lucky enough to be down in Florida right now in the nice weather, you can always call in and talk to us over the phone as well. We'd be more than happy to take the time to talk about your credit capacity, to look at your credit and see what needs to be fixed, or see if we can help you with a debt consolidation loan, because this is the time of the year where a lot of us need help with that. All right, I think it's that time where we're going to open this up for questions. So Matt and Jamie, were there any questions that we had out there that we can address for the group?
Yes, first off, wonderful job, Brock. Thank you very much for that. That's a lot of information regarding the importance of developing and maintaining a strong credit score. So we do have some questions, so feel free to, again, address those to Jamie Baker or myself if you still have them. We still have time to take them. But just a few here. The first one is, how do you determine how much someone can get on a debt consolidation loan? I have a lot of credit card debt.
Okay, that's a good question. Good question. There's a lot of things that go into how much you're gonna be able to qualify for. We do take a look at your credit so we can see how much you've handled before in the past. We take a look at your income, see how much money you make, because the one thing that we don't want to do, and one thing we have to be careful of, is that we don't put you in a worse financial position, right? So if you have $50,000 in credit card debt, we can't always just give you a $50,000 loan, because it could be a huge payment on a $50,000 loan, right? And we don't want to put you in a worse position than you're already in. We can get in trouble for that. And just from a personal perspective of how we like to treat our members, that's not a position we want to put you in. Okay, so we look at things like your credit. We look at how much money you make, how much you've handled before. We look at your relationship with us, with Michigan First too. And then we make a determination of how much we're going to be able to help you with. Now, I can tell you that the majority of the time that I've looked at debt consolidation loans, we don't knock out all the credit at once. There's a lot of times where we have to take it out in chunks, and that's okay. That works. You have to be patient with that model as well, but any bit helps, right? Any bit helps to get that debt paid off. You got to take that first step sometime, and just taking out it at little bit chunks too is still going to help your score, right? If you free up 25% of your capacity, you could still see a 25-point increase on your score, and that's not nothing. That can take you from a B score to an A score. And when you increase your credit score, the ultimate goal here is to get the highest credit score. And the reason for that is, if you have the highest credit score out there, A+ credit, When you go out and borrow money from banks, credit unions, and finance companies, whether it's for a mortgage, a car, or any other type of loan, you're going to get the best interest rate possible. You want to get the best interest rate possible because if you do, your payment's going to be the lowest possible. And that's just going to save you money out of your pocket. That's what the end goal is for all this, is to put dollars and cents back into your wallet. Because especially these days with everything costing so much more, I tell you what, if I had an extra $20, $30 every time I went to the grocery store, I would kill to have that right now, right? So that's what we're trying to do. Get your credit score high so you can pay less money on your loans.
Well put. Thank you. Another question here is, are store credit cards just as good as credit union or bank credit cards?
Well, that's an ambiguous question. It depends on what you mean by good. Usually store credit cards can tend to have annual fees, and you don't want to pay annual fees if you can help it on your credit cards, because really that's just money you're throwing out of your pocket. Store credit cards tend to have very high interest rates, so they're harder to pay off. But as far as the capacity perspective, those still help your capacity, right? So what we do a lot of times is, look, I know it's very tempting when you go to Kohl's, when you go to all these stores and they say, hey, we'll give you 40% off your purchase if you open up a Kohl's card. Cool. Yes, let's do that. And that's fine. You can do that if you want to do that. What we like to do is after you've done that, come in and see us, do a debt consolidation loan to pay those off. Get those out of the credit card balances and onto a debt consolidation loan balances. You freed up all of your capacity with those cards and you don't got to use them anymore. You used it for the purpose. You got the percentage off. Now you pay it off with an installment loan where you have a set term where you can pay it. So to answer your question, I think they can be bad as far as the interest rate and the fees associated, but they're also good for helping your capacity. So after you pay them off, do not close them, because if you close them, you're going to lose all that capacity.
All right. Thank you very much. Another question here. This is kind of a two-part question regarding the same kind of thing, but who do we call if we want to increase our limit on our credit card with Michigan First? And the second part of that is, how long after opening a credit card is it typically okay to ask for a limit increase?
We'll handle the first one because it's the easiest. Just give us a call and apply for an increase on your credit card. The process doesn't take very long. You'll speak with one of our loan financial service representatives. If you call over the phone, they can put that application through quickly, and they can let you know what your credit score is at that time, and they can give you some other advice in the same call as far as what else you can do to help your score. And then one of our underwriters will take a look and see if we can get you that increase. So to call a 1-800 number, follow the prompts, will get you to our lending team. The second part of that question, what was that again, Matt?
How long after you take out a credit card is it
Oh, yeah.
okay to ask for a credit limit increase?
Yep, there is no time limit. It depends on your situation. You could technically call the same day after you've gotten approved for it and ask for more. And that's not always a bad thing, right? There are some members of ours who will call in and they don't want to overburden themselves with a high limit. So they'll say, I only want $1,000 credit card. Okay, and we'll say, okay, are you sure that's all you want? You know, we'd approve you for more. And they say, no, I just want 1,000. I'm like, okay, so we'll approve it. They could call the next day and say, you know what, I rethought about that and I would like to get more, and we could approve them for more. So it kind of just depends on the situation. But to answer the question directly, there's no time limit. It just kind of depends on the situation. Now, in the same scenario, if you called in and asked for a $10,000 limit, and you went out and spend it in one day and you called the next day and asked for another $10,000, maybe we'd say, well, hold on a second, what's going on right now, and ask you some more questions. So that maybe won't happen. It's all situational, and we'll always have your best interest in mind and give you the best advice possible when it comes to that.
Great. Thank you for that. Couple more questions coming in here. One is, what is the A+ top score range for the credit union?
If you're over 720 for your credit score, you'll be in the A+ range with us. Now, one thing I also want to mention, I always kind of throw this in there at some point in the presentation. A lot of you will have the apps on your phone that track your credit score, okay? Credit Karma is a really popular one, and there's quite a slew of them out there actually, called all sorts of things with credit in the title. Those apps use a different model than what banks and credit unions use. They use a model that's called Vantage. The credit unions and banks that are out there use a model that's a FICO model. I'm sure some of you heard of FICO score before. So the Vantage model that those companies use goes up to 950. All right. So we don't have any 950s here in the banking world. So those apps are great for tracking your credit. If anything changes, like they can send you alerts and stuff on your phone, but don't take their score to heart, because that's not the correct score. That's not the score you're going to have if you come in and apply for a loan with us. Well, we've had several members over the years come in happy that they think they have a 920 credit score, and then we pull it and it's a 700. Our models aren't the same. So it's apples to oranges there, and they usually get mad at us because we're telling them that their score is not as high, when really it's just because they're using two different models. So just be leery of that. But for the models that we use here at the credit union and the other banks and credit unions use, typically 720 is where you're going to be at that A+ range.
Great, thank you very much. Another one on the credit limit increase, another piggyback off of that from a member is, will your credit be reran for a credit increase, causing a hit on your credit?
If you call in and initiate it, yes, it will. But I can tell you this. There's a misnomer out there about how bad your credit gets dinged for getting a hard pull. Your score will only drop a few points if you get your credit ran. Okay. But again, in that example that we talked about earlier of how much you can gain on your capacity, if you call and get an increase on your card, and even if you raise your score 10 points, it more than makes up for that hard pull on your credit. Okay. And additionally, the further you get away from a credit pull, the less it affects your credit score. So it might have dropped your score a few points that month that it happens, but it's going to go away in a few months. Okay. The only time you're really going to get yourself in trouble with credit pulls is if you go credit crazy and you go shopping all over the place and have a bunch of companies pull your credit. That can really tank your score, because now we're talking a few points times 10 or 20. That's 20, 30 points. That's really the only way you get yourself in trouble. Having Michigan First or another company pull your credit to have a credit increase done, it's really not going to make that big of an impact on your credit score. But we've all been scared into that by things that you read and credit counseling companies, they like to call themselves, or sometimes I've had my cousin try to tell me things about credit, and I'm just like, that you're not getting that from anywhere that's substantial. So don't worry about that. But it is a hard pull if you call in. Now, a couple times a year we do soft pulls on our members' credit to see if we can increase their limit just on our own. Soft credit pulls don't affect your credit score. Okay. Hard credit pulls do. So when companies out there, there's several people can do soft credit pulls. When you go to apply for a job, they can pull your credit as part of the employment process. That's a soft credit pull. It doesn't even show up on your credit report, but they can see your score and see what's on your credit report. We can do the same thing here at the credit union. So we'll do a soft pull on all of our members who have credit cards with us to see if they could benefit from an increase on their limit, and we'll do that during the year. But if you call and initiate it, it is going to be a hard pull.
Great, thank you very much. And then another question, I think you touched on this a little bit in your presentation, but what are some suggestions you have to avoid using my credit cards too much after doing a debt consolidation loan or paying them off completely?
Well, that's more internally driven from you to try and not spend more than what you have. The trouble you can get into with a debt consolidation loan is if you pay all your credit cards off and put it on an installment loan, you're going to have a payment on that installment loan. but you're not going to have those credit card payments anymore. But if you charged all your credit cards back up, all of a sudden, not only do you have those credit card payments, but now you have this other loan out there that you have payments on too. You've put yourself in a worse spot. So you have to be diligent in yourself to not go out and spend money on your credit cards after you do that. Now, I know that in today's society, and even myself, we put a lot of things on our credit cards. You get rewards points on certain credit cards. It's just easier to swipe that thing. You don't want to do it with your debit card because you don't want your debit card information out there or whatever. We use our credit cards all the time. We use them for emergencies. If you get a flat tire and you don't have an extra $400 or $500, you swipe it on the credit card and you take care of it. You just have to make sure that if you do that, you can pay that balance off at the end of the month, or make yourself a plan. Hey, I had to buy a tire for my car. It's $400. I'm going to pay 200 of it this month, and next month I'm going to pay another 200. Just make yourself a budget. Take how much money you're making a month, take out all of your expenses, and see how much money you have at the end of that. You don't want to spend more than that on your credit cards because you can use that money to pay your credit cards off at the end of the month. You just have to be really careful if you do that debt consolidation loan that you stick to that plan and not put yourself in a worse position.
Very well said. I think I have one last question here, and that is, where will there be a link for this that we can download?
Yep, you will be able to find this recording on our website. So it'll be easy for you. And in fact, I think some of our old ones might be on there too. So if you want to see my ugly mug more than just today, you can go back and see it on some of the old credit seminars.
Hey, great. Looks like we've
That
addressed.
that was your cue to say I'm not ugly, Matt. Thank you.
Oh yeah, that's I you're not ugly, Brock.
Okay, thank you.
Okay. So it looks like we've addressed most of the questions, and we're getting close to the end time here. So if you have additional questions or you're interested in discussing your individual credit situation with one of our credit professionals, please visit one of our 34 branches across the state. You can call us at 800-664-3828 or visit us online at michiganfirst.com. So on behalf of our nearly 500 team members, we thank you all for participating and for supporting Michigan First Credit Union. That's all for now. So until next time, have a wonderful and prosperous 2025. Thank you very much.
Thanks, everybody. Have a good day.